Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good afternoon all. Ira Epstein of Linden Associates with your agriculture update. And this video is for Thursday, the 16th of March, 2017, just after 3 p.m. Central Standard Time. A small rally day in all the grain markets, cotton even up just a fraction along with the sugar. So we didn't go anywhere. We did see the dollar get hit another half a point today. That's quite a bit actually since those highs that it recently saw. And most of the stock indices are going to finish off the day unchanged to slightly lower. So after yesterday, everybody taking a pause, if you will, in the marketplace. When we look at May beans on a weekly chart, you can see that you've come off these lows of 9.83 now by about 18 cents. You're up to 10.01 and a half, so we've had a bit of a bounce. And as you can see right here, the bounce on a closing basis, we haven't gotten over previous highs or set up a pattern yet to stop the overall down thrust. Now, if you price soybeans, as my company did in the Brazilian reals, you can see the market is headed down again. A lot of you know that we put out what's called price counts. And price counts are another tool that help you figure out where a market might go once a trend kicks in. And we teach you how to define that trend, when it kicks in, and where prices might go. So we just think this is still just a bounce in a market. And you can see how this is working here. You've just now got 3 days in a row where you had ranges that keep narrowing in. We're not taking out the previous day's highs or lows. And you see that with the swing line. Now, should you take out 10.07 3/4, you could, in fact, at that point, end up with a pattern of higher lows, higher highs, which could kick the market up. However, you've got to look where it could go. And because you're under the 18 and the 100-day average of closes, maybe you get back to the 10.22 area, but that would be, from what we're seeing right here, the first resistance point. What has supported the market is the lower Bollinger Band that you came down and you hit. In a series of succession, we've moved to the right-hand side of it, and now the market has to decide what next. And what keeps me in the bear camp is that the slow stochastics converted from oversold into going sideways under 20, which I term embedded. In other words, locked in. And until the red line closes over 20, regardless of what the swing line does, this takes the leadership and it says, no, rallies are still being sold by the pros. The same situation is in the meal. In fact, in the meal, you've had the pattern of lower highs, but now you got higher lows. So to get the trend back in place, you got to take out 526 and a half, but you've got the embedded reading. And what else? Look at the 100-day average, and I have pointed out, I believe here in this, that that's acting as the support with the lower Bollinger Band. So could we kick up to the 18-day average? Yes. The key is going to be what happens. Do we come back and get rid of the embedded readings and just become oversold and correct that? The soybean oil is just oversold. This is what oversold often looks like. The pattern is lower highs, lower lows under the 18-day average. Let's assume that yesterday's highs, the 32.69, are taken out. Where do you think the first resistance might be at that point? I'd argue the 18-day average of closes, 33.18. Could, if that happened, we set up a bull trend again? Yes, if you close over 33.18, because you'd be correcting an oversold condition, been over that number with higher lows, higher highs. So that's one possibility. Notice where the corn market stopped. Look at that 100-day average and what I teach you. When you first get under it, it's not uncommon for the market to fight to get back over it. And that's exactly what you're doing because you've been under it such a long, over it such a long period of time that the first wave's under, you could get a bounce. But there's nothing here that's bullish on this chart. If we start taking a look at the chart action, we have today's numbers in the slow stochastics. Both are under 20. Day before, both under 20, and the day before. You have fully embedded readings, and until you lose them, you're still playing the short side. On the wheat market, you're trying to get those embedded readings. The market's having trouble at that 100-day average of closes. It was trying to get up to the 18, but that's going to be hard. You got to first get through that 100, and it's not easy once you stay under it a few days. Now, in the sugar market, you had a nice rally, but I think the pros were hitting the market here until you lose the embedded reading. Should you take out the 1810 level, this market just might have the power to drop down for another wave, possibly to that 1734. Lose the embedded reading, and I think you go all the way back up to the 1908 level. So very important on the charts, but the bears are ruling the day. Coffee lost its embedded reading, got back, as I suspect, to that line in the sand, that 18-day average in close in red, and the market just sort of stuck right there, not trending. You've got the swing line up, but you're under the 18-day average. There's no trend at all. And in the cocoa market, as I pointed out, you rallied from here, got yourself into the upper Bollinger Band. Now you've begun the correction process. The question is how deep. The pros will probably look for support at 1968, the 18-day average of closes. But when you're this overbought, they're skeptical about just buying into the market. People do look at overbought, oversold conditions, and slow stochastics are not the only oscillator that does that. You got relative strength, MACDs, Williams percent hour. I can go on, which brings me to something. I'm starting to work with the first definitions of something new I'm going to do. I'm going to create libraries of videos that teach you different trading tools, not a course. But let's assume pivot points. What's the popular way to use them? Let's assume relative strength index. What's the popular way to use it? So I'm going to start creating that in videos, and you'll be able to see them and come to them as a library and how to work with them, at least my interpretation of it. Okay, in looking at what we've got here, we have a higher high, a lower low. There is no trend. The bias is up, and we know that because you fell back, found support at the 18-day average, and it managed to stay over it. But there's nothing clear-cut here on the way of a trend. The cattle market's a son of a gun. This thing's trying to break out to the upside over the upper Bollinger Band. If it does it, this is enough of a base to have a heck of a move. I got to tell you, this is that sideways action. You are overbought, so the odds favor it's not going to be able to stay over it very long. Let's see what it does. In the feeder cattle, you're pushing out that top band. This is what fats might do. And this base is not the longest base, but it's a good enough one to kick this market up beyond the levels that the trade thinks. And I think you've caught a lot of traders here because I've heard so many people being bearish this market. In the hog market, you're still in the friendly camp. You're overbought, trying to correct that condition, but you have an uptrend. Higher lows, higher highs, hit the upper Bollinger Band, slipping back. If you rally again, you'll still have resistance there. Support's closer to the 68.50 level. I want to remind you that if you do what I do and other traders, many of us try to look and see, can we get an edge understanding seasonal trades? And that's where the more research comes in, one of the best known services for this. Now there's caveats, and this is how their service looks. You get the months like this is February and March. Now you got March and April, and then you're going to get April and May. And they'll show you the trade dates, how many years it has worked out of the past 15. If it doesn't work at least 13 out of 15 years, it won't appear there. You can play with the longest times of trends. You go back 30 years, 5 to 15. Their service allows you to go back and really experiment with everything that they've got. How you get this, you get a 2-week trial by either calling us, going to our website. You can even click up here if you'd like, and we'll be able to take it and send your information to them, and they'll put you on it. Now, let's understand the limitations of what seasonals are. Because something has worked, let's say, 13 out of the past 15 years, does not mean it has to work on the 16th year. Always pay attention to your technical work. Use this as another tool. And that's the way that we here use it. I'm Ira Epstein. Take advantage of this. I think you'll find it another piece to your trading arsenal. Have a great day.